Student loans at FHA, new guidelines explained right here, right now. If you're considering an FHA home loan and you have student loan debt, I have really great news to share today. HUD recently made changes to the program and the way that debt to income ratio is calculated that's going to allow more buyers to qualify for FHA loans. I'm going to be breaking down all the details, but before I do, please do me a favor and subscribe to this channel. I've been helping people realize the dream of home ownership for over 25 years. Wow. And I truly have a passion for home loan education. Please subscribe and be part of this community. Okay, so here's the scoop. In the past, even if student loans were deferred, we had to calculate a payment into the qualifying debt to income ratio of 1% of the balance on that student loan debt. As a reminder, debt to income, or DTI, is the calculation that lenders use to determine the overall debt as it relates to the total usable income for the home loan. If you want more information about debt to income ratio, please check out the link below. I've got a whole video on it. Imagine that. Anyway, let's take a look at the numbers and the impact of this change. So 1% of that deferred student loan balance, let's call it $100,000 in student loans. And honestly, guys, I see that. I see it all the time. So $100,000 in student loan debt that, let's say, is deferred, meaning that there is zero payment reflected on the credit report because that loan is not in repayment yet. But from a lending standpoint, we still have to calculate a payment into the qualifying debt to income ratios. Prior to this change, that payment calculation for FHA was 1% of that outstanding loan balance. So on a $100,000 loan, 1% was $1,000 per month that was calculated into the qualifying debt to income ratio. Now with this change, that percent drops to 0.5%. So on that same $100,000 loan, now $500 is calculated into the debt to income ratio. Guys, this is a game changer because it will allow people to use FHA loans more often when they do have student loan debt that is deferred. Now, as a reminder, that is only for student loans that are deferred. But if there is actually a payment reflected on the credit report, then lenders can use that payment for qualifying purposes. Or if there is a documented payment that one has worked out with their student loan company, then that payment can be used as well. This means increased purchase power and better chance of home loan approval. Now, FHA is one of those programs. They have been around a long, long time. And it's really such a great benefit, not only for first-time home buyers, but anybody that maybe has had some credit challenges or has had life happen, such as bankruptcy, foreclosure, and short sale. There are two loan programs out there that we use most often. And that's going to be conventional, which allows for a 3% down payment, and FHA, which allows for a 3.5% down payment. But how these programs work and are orchestrated are materially different. And so again, for FHA, if you have a credit score under 680, it's probably the better option because the cost of mortgage insurance on an FHA loan is a flat figure. It is not based on credit score. Whereas on conventional, that's where you start to see under a 680 credit score on a conventional home loan, that mortgage insurance gets very, very expensive because on conventional home loans, the cost of mortgage insurance is driven by the credit score. So there are a lot of different pros and cons to any home loan program out there. What I really suggest and recommend is talking with an experienced loan professional that can walk through your particular scenario and give you guidance based on the options available to you. And if you're in Arizona, California, or Colorado and you'd like me to put together numbers in an analysis for you, please feel free to call or text 480-725-0150. Otherwise, if you have questions, comment below. And don't forget to like, share, and subscribe. Until next time.